What is up, guys? Mike Wang here. In my last video, I talked about the importance of understanding the commodity market for both traders and investors. So today I'll be talking about the king of commodities, gold. I'll be going over a brief introduction of gold as an asset, how you can trade and invest in it, the factors that affect the price of gold, as well as trading strategies. As always, before we begin, don't forget to smash the like button and make sure to subscribe if you haven't yet. Without further ado, let's dive right into today's video. So do you know why gold's bullish trend reversed during the financial crisis in 2008 and why it's likely to continue rallying after the COVID crisis in 2020? If you finish watching this video, you'll be able to answer that question with ease. So forget about the definition of gold and its history. If we just quickly take a look at the use of gold, gold can be used as a currency, jewelry, a luxurious good, or a means of investment and for industrial use. But what's really important for us to look at is the fair value of gold and how we can invest in it and trade it from the perspective of an investor and trader. So let's take a look at the factors that affect the price of gold. There are a lot of factors, but here are 7 that I think are really important. The first factor is the dollar index. I explained the concept of a petrodollar system in my other video, which you can check out by clicking the top right corner. But under this system, all commodities are basically marked by the US dollar and traded based on the USD price in order to maintain the United States dollar's status as a key currency. The euro and Chinese yen are increasingly continuing to play a bigger role in the market, but the USD remains the standard. So when the value of the dollar decreases, gold's price, which is marked by US dollars, increases, as we can see in the inversely correlated price action in the graph. The second factor I want to talk about is the real yield, which is actually very important. The real yield, or the real interest rate, can be calculated by subtracting the nominal interest rate by the rate of inflation. So for instance, let's say that there's a bond with a yield of 5%. This means that if you invest $100, you'll get a return of $5 every year. But if the inflation rate is 2%, this means that the value of the cash depreciates by 2%, so essentially you're only making 3% in profits. The higher the yield, the lower the price of gold, and vice versa. And as we can figure out from this equation, the higher the inflation rate, the higher the price of gold. To better understand this, think of another example. Let's say that a bond's yield is 4%, but the inflation rate is 6%. Essentially, your real yield is negative 2% according to the formula, right? This means that if you invest in bonds in this situation, you're essentially losing money. The higher the inflation rate, the lower your return. In a situation like this, gold is considered a good investment as it preserves the value of your wealth. So in conclusion, a bond's yield and gold's price move in opposite directions, and the inflation rate moves in the same direction as gold's price. Sentiment is another very important factor that determines the price of gold. Basically, it's an indicator that tells us whether market participants are bullish or bearish on gold. There's no way to clearly quantify the market sentiment, but a good way to approach it is to look at the fear and greed index or to look at gold's positioning within the futures market. Nowadays, there are also advanced ways of using machine learning to collect data from the news in order to figure out the market sentiment. So we just went over 3 factors that affect the price of gold, and these are actually the 3 most important factors. The 4th factor I want to talk about are the Fed's balance sheet and M2 monetary supply. So if we take a look at this graph, we can see that the Fed's balance sheet is marked in blue and the price of gold is in yellow. We can see that the Fed initiated quantitative easing in 2008 and bought in a lot of treasury bonds. This trend continued throughout the years, and when the Fed wanted to slowly reduce the amount of treasury bonds, COVID broke out, and they had no choice but to increase the amount of treasury bonds they were buying in. And with this, gold's price skyrocketed. The second graph here is the M2 monetary supply. Just for your information, M1 refers to the cash we know, and M2 is a broader way of looking at money that includes things like deposits. So if we look at how things unraveled during the beginning of the COVID crisis, with quantitative easing and economic stimuli, the M2 money supply increased quite dramatically dramatically. But in 2008, despite having initiated quantitative easing, the money supply didn't really increase by a significant margin. As such, we saw a huge spike in the price of gold, only to see it dump back down almost immediately. I'll explain why this is the case in more detail. So if we look at the graph here, the line in red is the money supply. The green line represents the Fed's assets, and the blue line represents the excess reserves of financial institutions. It's basically the money that institutions have for contingencies. So prior to 2008, financial institutions barely had any excess reserves, as you can see, which is why they almost all went bankrupt during the financial crisis. So when regulations were established later, banks were required to increase their excess reserves. So the money that was supplied through quantitative easing didn't flow into the market and help consumers spend and institutions invest as it should have. So when regulations were established later, banks were required to increase their excess reserves. So the money that was supplied through quantitative easing didn't flow into the market and help consumers spend and institutions invest as it should have. It instead flowed into the financial institutions and were used to help them rack up excess reserves. So there was barely any change in the money that actually circulated among economic entities. In other words, the money velocity didn't increase. But in the case of the COVID crisis, what we saw wasn't a problem of the financial system. Financial institutions were actually very healthy at the time. So while some of the money that was supplied through QE flowed into financial institutions again, most of it was actually supplied to the right economic entities, increasing money velocity and market liquidity, which led to an unprecedented bull run. So unlike 2008, the price of gold is less likely to drop and more likely to continue rallying upwards. The fifth factor that affects gold price is the stock market. When the stock market shows a bearish trend, gold is considered a safe asset, so it goes up. In a similar vein, when the volatility index increases, gold's price increases along with it. But in reality, gold's price action in relation to the stock market, as you guys can see in this graph, is a little more complicated than the case of if A then B. So it's not as important as the other four factors that I previously mentioned. The sixth factor is the demand for gold as jewelry. This demand is inversely correlated with investment demand. People want to invest in gold more when the price of gold increases, but they're reluctant to buy gold as consumption simply because it's now more expensive. Lastly, we have the supply factor. For gold, the supply factor is not as important as that of other commodities. There are three components to gold supply: gold mines, gold recycling, and supply from either the government or the central bank. Gold mining is inelastic to change in price. Just because the price of gold changes doesn't mean that the supply changes accordingly as well. We also refer to gold as a demand-led market. So how can we invest in gold? There are mainly three ways that retail traders like you and myself can approach. First, we have a method of purchasing physical gold bars, gold watches, whatever. Second, we have gold ETFs like the SPDR Gold Shares, ticker GLD. And we have gold futures and options for number three. Besides these, there are other methods like swaps and certificates, but you don't need to worry about that. These are the three main methods that you can trade and invest in gold. So now most of you guys will probably be trading gold ETFs, but here's something you really need to keep in mind before you do so. It's best not to trade leveraged ETFs. GLD is one of the most popular gold ETFs, and they actually possess physical gold. But in the case of a leveraged gold ETF like UGL, they trade gold futures. And as we all know, futures have expiration dates. And when the expiration date comes, they need to sell their current future positions and buy new ones. This is referred to as rollovers, and the rollover costs are not only high, but in the case of leveraged ETFs like UGL, the rollover cost is consistent. And if you compare the cumulative returns for both ETFs, they're basically the same. So if you're looking to invest in gold through ETFs, I highly recommend that you do it through unleveraged ETFs like GLD. So moving on to gold trading strategies, the gold market is a market where technical analysis actually works very well. That's because it's a market where the sentiment of the market participants is important, and because market participants have a tendency of valuing the technicals. So just to take a brief look at the gold's technicals right now on the weekly, we can see that it's painting a major cup and handle pattern on the weekly. We're currently completing the handle where we have formed a broadening descending wedge. We broke out of that pattern and retraced back to test the resistance turn supports. We can see that a reverse head and shoulders pattern is taking place, so I'd expect the bullish rally to resume in the coming months. So that is it for today, guys. I hope this video was helpful in explaining the factors that affect gold's price and how you can trade gold. I'll be following up with more videos on commodities soon. If you like this video, don't forget to smash the like button. Subscribe for more quality content, and I'll see you guys in the next video.